This has to do with the Fed?
Well, look, I think part of this obviously has to do with concerns about growth and whether China's a leading indicator or not. But I think we have to bear in mind that what the Fed did, and I was part of that group, is we front-loaded a tremendous market rally starting in 2009, in March of 2009. It's sort of what I call the reverse wimpy factor. Give me 2 hamburgers today for 1 tomorrow. And I'm not surprised that almost every single index you can look at, if you take away dividends in the S&P last year, unweighted was down significantly, and all the other indices were down. In terms of the 10-year bond, there was almost no movement for the year. Basically, we had a tremendous rally, and I think there's a great digestive period that's likely to take place now, and it may continue because, again, we front-loaded at the Federal Reserve an enormous rally in order to accomplish a wealth effect. So I wouldn't be surprised at what's happening. I wouldn't blame it on China. We're always looking for excuses. China's going through a transition. It'll take a while to affect itself. But what's new there? There's no news there.
Well, I mean, a 7% plunge in their market is a scary thing to wake up to for U.S.
Bear in
investors.
mind, we have to, I've been going to China since 1979. I was part of the group that negotiated with Deng Xiaoping the normalization of our commercial claims against each other and closed that deal on March 1st of 1979. So I think I've got a little bit of experience in China. I invested in China for quite a period with my fund in the B shares market. You have to remember, Shenzhen, Shanghai are basically domestic markets. They're trying to manipulate those markets as much as possible. Jim Cramer was right on this morning in terms of the force that they use to prevent real animal spirits from emerging. But the real issue there is their underlying economic transition. The markets are not correlated with that in China. They're achieving it. It takes a while transitioning from poorly run state-owned enterprises, a bad credit system, an emphasis on volume and production, to quality and consumerism and profitability. This is going to take some time. It's a good thing. And I don't think there's any news there whatsoever. But again, analysts are always looking for a tripwire. The fact is, we've had a great market movement since 2009. It's going to take a while to digest this. I wasn't surprised at last year, and I wouldn't be surprised at a rather fallow performance this year as well.
Well, I guess then the question, Richard, is how ugly is it going to get? There was a point yesterday where the Dow was down 467, and everyone was trying to figure out, to your point, why? Does the Chinese stock market really affect us? If you do see this as this big unwind from Fed policy, which fueled, what, a 6.5-year bull market, what does it look like on the way down?
Well, I was warning my colleagues, don't go wobbly if we have a 10 to 20% correction at some point. The market's still overpriced. Everybody you talk to all morning long, from Byron on, have been warning that these markets are heavily priced. We're trading at 19.5 times earnings. We're not having the kind of top-line growth we would like to have. We're late in the cycle. Things are richly priced. They're not cheap. They may not be overpriced any longer, but they're certainly not cheap. So all the managers that I talk to in my role at Barclays, and that's quite a few across the world, a lot of people are building cash positions. The rates traders are different, but I'm talking about the long-only investors, or those that are taking a longer-term view, are being extremely cautious here. They're raising their cash levels, are nervous about the valuations that are in the market, and they realize the old dictum from Ben Graham and Warren Buffett, price is what you pay, value is what you get, and the values are very richly priced here. So I could see significant downside. I could also see just a flat market for quite some time, again, digesting that enormous return the Fed engineered for almost 6 years.
Richard, this digestive period, does it usher in an era where assets can't perform in the absence of accommodation? Is there something new about this, or is it the same old cycle regarding equities and rates?
Well, first of all, I don't think there can be much more accommodation. The Federal Reserve is a giant weapon that has no ammunition left. So what I do worry about is it was the Fed, the Fed, the Fed, the Fed. For half of my tenure, which was a decade there, everybody was looking for the Fed to float all boats. And they, in my opinion, they got lazy. Now we go back to fundamental analysis, the kind of work that used to be done, analyzing whether or not a company truly on its own is going to grow its bottom line and grow its shareholder value and price accordingly, and not just expect the tide to lift all boats. So we are going to find out indeed when the tide recedes. We're going to see who's wearing a bathing suit and who's not, and we're beginning to see that. You saw that in junk last year. You also saw it even in the mid caps. You saw it in the S&P stripped of its dividends. You had on an unweighted basis, you had a negative return. The only asset that really returned anything last year, again, if you take away dividends, believe it or not, was cash at 0.1%.
Yes.
That's a very unusual circumstance.
This is, Mr. Fisher, this has been an absolutely extraordinary interview. For you to come on here and for you to say I was one of the central bankers who engineered the front loading of the banks. We did it to create a wealth effect. And then to go on and tell us with a big smile on your face that we're overpriced, which was the word that you used in the market, that there would be some digestive problems. Are you guys going to take the rap if there is a serious correction in this market? Will you equally come on and say, I'm really sorry, we overinflated the market, which is a logical conclusion from what you've said so far in this interview?
Well, first of all, I wouldn't say that. I voted against QE3. But there was a reason for doing this. Let's be fair to the central bank. We had a horrible crisis. We had to pull it out. All of us unanimously supported that initiative under Ben Bernanke. But in my opinion, we went one step too far, which is QE3. By March of 2009, we had already bought $1 trillion in securities. And the market turned that first week in March. To me, personally, as a member of the FOMC, that was sufficient. We had launched the rocket. And yet we piled on with QE3, understandably worrying, the majority did at least, that we might slide backwards. So I think you have to be careful here and frank about what drove the markets. Look at all the interviews you had over the last many years since we started the QE program, quantitative easing, and it was the Fed, the Fed, the Fed, the European Central Bank, the Japanese Central Bank. What are the Chinese doing? All quantitatively driven by central bank activity. That's not the way markets should be working. They should be working on their own animal spirits, but they were juiced up by the central banks, including the Federal Reserve, even though some of us would not support QE3.
Richard,
so I think you have to acknowledge reality.
We're totally out of time. One word answer. The Fed forecasts 4 rate hikes this year. The market says it'll only be half of that. Who will be right?
I thought John Williams' interview was very good yesterday. I'd bank on that.
Well, he says the Fed is going to go through with their forecast. Richard Fisher, always a pleasure. Thanks for joining us, the former president of the Dallas Fed.